Welcome to Market Peeker. In today's episode, we're going to explore major currency pairs and what makes them so important in Forex trading. Whether you're new to Forex or have some experience, understanding the major currency pairs is essential for successful trading. Let's dive in. In the Forex market, currencies are traded in pairs. When you trade Forex, you're always buying one currency and selling another. The major currency pairs are the most traded and widely recognized pairs in the world. These pairs include the currencies of the largest and most stable economies, and they tend to have high liquidity, meaning they're easier to buy and sell. The four most commonly traded major pairs are 1. EUR/USD. This is the euro versus the US dollar. It's the most traded currency pair in the world and is known for its high liquidity and relatively stable price movements. 2. USD/JPY. This is the US dollar versus the Japanese yen. This pair is popular for its strong relationship to economic and political events in Japan and the US. 3. GBP/USD. This is the British pound versus the US dollar. Traders often refer to this pair as cable, and it's known for its volatility and the influence of UK political and economic news. 4. USD/CHF. This is the US dollar versus the Swiss franc. The Swiss franc is often considered a safe haven currency, meaning it tends to hold its value during times of global uncertainty. There are also commodity pairs, which include currencies of countries that are heavily reliant on the export of commodities. The most well-known commodity pairs are 1. AUD/USD, the Australian dollar versus the US dollar. Australia is a large exporter of commodities like gold and iron ore, so this pair can be influenced by commodity prices. 2. USD/CAD, the US dollar versus the Canadian dollar. Canada is one of the world's largest oil producers, so this pair is closely tied to the price of oil. 3. NZD/USD, the New Zealand dollar versus the US dollar. Like Australia, New Zealand's economy is heavily influenced by commodities, particularly dairy and agriculture. The first currency in a pair is called the base currency, and the second is the quote currency. The price of the pair tells you how much of the quote currency is needed to buy 1 unit of the base currency. For example, if EUR/USD is trading at 1.20, it means that 1 euro is worth 1.20 US dollars. Major currency pairs tend to have lower spreads, which is the difference between the buy and sell price. This makes them attractive for traders, as lower spreads can mean lower transaction costs. Also, these pairs are generally less volatile compared to exotic pairs, making them more predictable for traders who prefer lower risk. Trading major currency pairs offers plenty of opportunities for both new and experienced traders. Since these pairs are so widely traded, there's a lot of data and analysis available to help you make informed trading decisions. Their liquidity and lower spreads make them a great starting point for anyone entering the Forex market. That wraps up today's episode on major currency pairs.